Good morning, I'm Bill Hubard, Chief Economist at Trade.com, and welcome to our weekly market wrap here at Core Finance. And we're honored again this week to have Jeremy Stretch, Chief Foreign Exchange Strategist at CIBC. Well, I guess, Jeremy, with the ECB today, a total non-meeting by the Fed next week, and then, of course, the Bank of England next Thursday, probably there's really nothing much to talk about, right?
No, nothing at all. We'll move along, please. Await for Thanksgiving.
So let's get the first chart up here, okay? 12:45, the announcement. 1:15, the explanation, okay? Are we expecting any curveballs, any surprises?
Well, I think Mr. Draghi's taken a leaf out of the ECB's, out of the Fed's playbook, I should say, in so much as if you leak the majority of the information or provide source stories
Would that be fake news?
Indeed. If you put the majority of the news out into the market, you can actually change policy, but without getting an extreme reaction. So I think what the ECB have been very careful and prudent in doing is saying, well, we are going to adjust our bond line. We are going to reduce it from the 60 billion a month that we currently have, most likely down to 30 billion. But then the debate becomes, how long are they going to extend it for? I thought that they would probably do 6 months, but now looking at some of the language that we've seen from the Chief Economist in particular, it may well be the case that they extend it for 9 months and obviously avoid the debate about the Italian elections in spring next year. And so we're going to see something in the region of a 270 billion addition in bond buying. That will pretty much take the ECB to the extremes of their current bond buying remit. But nevertheless, I think that's now largely in the price. And I suspect that any euro resilience we get in the initial announcement will dissipate in the press briefing.
Well into the range where well below that 120, 122 level that everybody was petrified about a month ago.
Well, indeed. I mean, if we think back to where we were at the September meeting, we've obviously seen the euro retreat some Saturday. That's obviously played into the hands of Mr. Draghi. Yeah, so we've seen the market retreat. So that does provide a little bit of latitude and a little bit of air cover for Mr. Draghi, because it's not necessarily the valuation that I think he was concerned about in September. It was more about the pace of the move. And I think the fact that we have seen a degree of retracement or at least consolidation, I think is encouraging. And so I think any impetus that we get on the announcement at 12:45, I think the balloon will be deflated when Mr. Draghi speaks at 1:30 by the perception of the language, talking about an open-ended process, reinvesting maturing bonds, making sure that the market isn't necessarily too concerned about early moves in the deposit rate. So I think all of that will probably mitigate against the euro getting significant traction today, and one suspect that we will see the euro just lightening up on the crosses through the course of the afternoon.
Because, I mean, if you look at the CFTC data, both for the euro and with sort of the bond market, they could be positioned, looking at the data, for disappointment if he doesn't do exactly what you just said.
Well, indeed, we've certainly seen some fairly significant positions being taken. So, in a sense, I think the ECB, as ever with all central banks, in fact, in the current environment, they continue to walk tightropes, and what they want to try and achieve is a messaging strategy which will allow them to move towards their objectives in terms of the inflation targeting in the context of the ECB without creating market instability. And I think that's why we've had this increasing mechanism of providing information to the market, leaks, sources, whichever way you want to cut it, to try and preclude a surprise reaction as and when rates are
well, now that you told me that this is sterling, now, we've got the meeting next Thursday, okay? I mean, after, I guess, overnight, you saw Jacob Rees-Mogg basically calling that Mark Carney, Bank of England governor, is the worst enemy in the UK.
I think he wasn't talking. Yes, he was talking in the context of Brexit, not just in general, but nevertheless.
So I mean, we've seen a massive move here. Okay? I mean, just a month ago it was 135, then we were well below 130, and then again, would you blame this on the CFT positioning? I mean, the market was expecting 130 lower. Okay, even if it was. The market priced in 80% plus probability of a move next week, but feeling it was going to be one and none, okay? Now, as we see right now, 132 plus. I mean, we saw about 160 pip move yesterday. after the GDP number coming in considerably better, meaning 0.4 rather than 0.3.
Well, if you take it to 2 decimal places, it wasn't even 0.4. But anyway, although I'm speaking as somebody who's been arguing that the bank shouldn't hike rates next week. So in a sense, I'm looking for the caveats. And in a sense, yes, the question is, we saw an extreme reaction in the wake of that GDP print. As I say, it's based on incomplete information. The ONS don't have a particularly good forecasting record in terms of data, and also because it's based on incomplete information, it is always revised. And I wouldn't be surprised in the slightest if subsequently the number is revised back to the 0.3 where the market thought it should have been. And I think that will be largely ignored if we've gone already and seen that rate hike coming through.
But I mean, again, most everybody was quite shocked in August of 2016 when we did get that rate cut, okay? Again, we're going to see it next week. Again, I'm like you. It's taken me a long time to be dragged into the yes, they're going to do it camp, okay? Has the market positioned itself, meaning that we saw the surprise move in cable up yesterday above 132? Would next week we said, oh yeah, what's
well, if you look at the way that if you look at the probability of a rate hike, we're now pushing 90%. So in effect, we pretty much got it priced in. So you would argue that at these sort of valuation levels, it's difficult to see additional traction coming in the sterling perspective, unless the language accompanying any hike, and of course we do get a statement to accompany it, and we also have the quarterly inflation report, unless that language is supportive of more than just one and done. Now, in a sense, you've mentioned about the surprise cut that we saw in August of last year. Is this just a reflection of removing that additional emergency reaction that the bank put in place at that time? But I think the bank has a problem because, of course, we are just about to get to the peak of the inflation cycle.
That's right.
So in a sense, the bank could be hiking at the same time as their inflation models are rolling over. So there is a real presentational problem, both if they hike rates and they try and defend their credibility, or they leave rates unchanged at the same time as inflation is going lower.
You're saying, and the people that I look up to, okay, these are the people that are in the market in the 25 to 35 range, okay, who remember raising rates when inflation was double digit, okay, and they're saying the same thing, okay. The simple fact is, whether it's the new normal or not, but we probably have, maybe we go to 3.1% inflation in October, then all of the 6 months, especially the oil prices and the concern hike that we got about the 2 hurricanes in the States, when we thought petrol was going to go up 6, 8, 10p a liter, and it went up 2, I think, okay? So it's a question of, will he have to walk the tightrope in the explanation?
Oh, absolutely, undoubtedly. And I think the fascinating thing, if the bank does follow through with their warning, and of course we shouldn't forget that really we saw this bandwagon really start with it was precipitated by that reference to incoming months in that September statement. Now, incoming months immediately meant the market thought the next meeting. Now, admittedly, that was 6 weeks after the previous statement, but that doesn't necessarily translate purely or compute with a reference to coming months. But clearly, if the bank do follow through with that rate hike, they are going to have to walk a tightrope, because the journalist in the press briefing will argue, well, what's the justification for this? Because we have ongoing Brexit-related uncertainty, the issues that were writ large in terms of the difference of opinion between the Brexit Secretary and the Prime Minister this week just underline some of the fundamental issues. We know about the problems on the consumer side. We're seeing big-ticket items starting to fall off very dramatically in terms of car sales. The housing market is decelerating. And yet, against all of that backdrop and inflation peaking, the bank is looking about taking away monetary stimulus. And I think that's going to be a very difficult balancing act for Mr. Carney. And one suspects if the bank does follow through with a rate hike, he may find his picture on the front page of some of the more tabloid newspapers next week with perhaps rather less favourable headlines.
Well, let's look at the euro, and I'm more interested in looking at the euro dollar from a dollar perspective, because although we've seen the euro now struggling about 118, but it was quite interesting yesterday. There was a better move, although we saw a massive move in sterling. There was a much better move in euro sterling, okay, well above the 89 level again, okay? And there are people out there saying, well, they see the euro, as you said, Draghi will give us what we expect today, and seeing it in the 90. And I mean, the people out there talking is possibly as high as 95 a year from now. But I want to look at the euro dollar from a perspective about what happens on the 31st of January, 2018, when Mrs. Yellen could be selling the big issue.
Yes, I mean that's the other. Yeah, there are several big variables in play in terms of the US side of the equation. One, of course, is the degree of fiscal impetus the US may or may not see, and whether you actually believe that's a substantial game changer.
That 25 basis points is done on the 13th of December.
Absolutely. I mean, we've consistently argued that we did think that was going to be the case, even when the market took to price that out earlier in the summer. We still kept that in our forecast profile.
Yes, me too.
So the market has come back to our point of view. I think the question is beyond the end of this year is what is the composition of the Fed board going to be? Because of course we fixate about the Fed chair, but Stanley Fischer left the bank on the 13th of this month. There are two Fed governors who seats are also available. So there's an enormous opportunity to shape the Fed here. And then alongside that you have the fiscal reform process and whether that's going to be a game changer. So there are big variables at play as far as the dollar side of the equation is concerned. I suspect that most likely we're going to get the Trump administration putting Powell in as Fed chair, as more of a steady as she goes type person who perhaps is quite keen on reducing some of the regulatory burden in the banking sector. But then the Republican right will get a little bit of red meat by John Taylor being put as vice chair.
Well, we saw when everybody said it was going to be John Taylor. I mean, all of a sudden it seemed like the dollar regained its mojo after being asleep for 6
Well, indeed. Well, yeah, because everybody wakes up and thinks, well, where does the Taylor rule put into US rates? Well, it's not 1 to 2. It's maybe 3 to 4 or 4 to 5. Now, of course, the issue is in terms of John Taylor, it's all very well operating a rules-based system in academia or even when you're advising politicians. When you're actually in charge of the policy remit, it's a bit like going back to Mervyn King in the dark days of the crisis and talking about moral hazard. Well, unfortunately, when the world is collapsing, moral hazard isn't necessarily an issue. So in the same context, having somebody who has very much a rules-based prescriptive process in terms of monetary policy in a key role in the Fed will create an interesting dynamic. Now, as I say, I think the Trump White House will probably have a yin and yang between Powell and Taylor, but clearly if Taylor were to get the top job, which is still not an outside possibility, then accordingly we would see the dollar move exponentially higher as markets reflect that rate expectation.
Because the point you just made about doing a 2-for-1 deal, both Fed chair and vice chair, probably with Powell and then Taylor, that seems to be where the bookies...
Indeed, I think that has been the assumption. We thought for some time that when we looked at the candidates for the Fed chair, we didn't expect Yellen to get the job or even want the job if she were to be offered it, because I think it's a non-symmetrical result for her. Because of course, if things go well, it will be Trump. If things go badly, it will be her fault. Yes. So I think there's little benefit or traction for her to remain in situ. And of course, she's an Obama appointee, so that is a very heavy negative. So in a sense, when we looked at the runners and riders that have been sort of discounted or put in the frame over the course of the last few weeks, Powell to us looks the most likely because he is most likely to maintain a low-rate environment, which of course is good news for the US economy or Trump's business, depending on which way you want to cut it.
The economy, of course.
They're, of course, indivisible, the success of both. But at the same token, perhaps, as I say, providing a little bit of a sop to those in the Republican Party who regard the Fed as too activist, perhaps too...
Now, the last chart I would have put up here is the real dichotomy, okay? We saw the Abe election, when the mayor of Tokyo decided not to run. I think he did far better expected. But to me, this is the real dichotomy. Dollar yen, 110 or 116 in the next 6 to 12 months.
Well, I suspect we'll see both. But I would suspect we'll see 116 first.
Okay.
So you're absolutely right. So Abe being re-elected, utilising the North Korean risk premium, which provided support for his base, I think does encourage the extension of Abenomics. It means that Kuroda is most likely to be reappointed to the BOJ. So again, we're talking about succession planning at a central bank. So I think Kuroda will maintain very easy monetary policy through the course of 2018. So I think that does suggest that dollar yen does go higher. We've found difficulty trading north of 114 with any conviction, let alone getting back to that 114.49 level. But I think if we can get through there's going to be a number of stops. There's talk about a lot of Japanese life companies in the second half of the fiscal year looking at unhedged foreign bond holdings. We haven't seen any evidence of that looking at the MOF flow data for those 2 or 3 weeks of this month. But nevertheless, I think that will be coming. So I think that does precipitate dollar yen going higher. But I don't think necessarily then you just extrapolate that trend, because of course that would raise issues in relation to the trade relationship between Japan and the US. And of course, we're still of the view that the longer term trend is one of a weaker rather than a stronger dollar.
Now, I want to let you know that we're not forgetting about you, because CIBC is a Canadian bank, okay? Yesterday, quite an interesting move on the loonie, okay, when the Bank of Canada said, thank you very much, no change.
Yes, the bank have certainly caused a great deal of excitement in terms of the way that they've been directing policy over the course of the last 6 months. So going back to June, we started seeing them providing the backdrop for monetary tightening. They followed that through in July. But then they caught some people in the market out in September by consecutive rate increases. And between July and September, they'd said nothing. And yet, between that period, we did have an important and substantive piece of data in terms of the Q2 GDP, which was materially stronger than expected. And if you read what they'd said in July, then being surprised in September was the wrong, you clearly missed the mark. But I think we've taken the view that some of that growth in H1 had been borrowed from H2. We are seeing a moderation in activity, and now the bank are reflecting on some of those deteriorating or diminishing trends. You've got the NAFTA risks on the one side. You've got the significant appreciation in the CAD that we'd seen between sort of May and August, also weighing on exports, so their export trajectory has been revised down. And Mr. Polis has suddenly reminded himself that he actually likes facilitating exports, and of course that needs a cheaper currency. So in a sense, the bank have now come back and said, well, we've reversed the policy easing, the emergency moves that we've seen in 2015, so we're back to where we would have been without that. And we'll now come back and we'll reformulate policy in probably April next year. So the bank, I think, are very much on the sidelines. The market had got ahead of itself. Classic case example of, well, we've seen 2 rate hikes. The next one, when's it coming? Is it going to be October or December? Well, in fact, now the market's being forced to reverse course, march back down the hill and say, well, policy is on hold until probably April, and accordingly we're seeing the Canadian dollar being unwound as a consequence.
So as you said, just very briefly, in the last 24 hours we saw a massive move in the Canadian dollar, a massive move in sterling. We see no change, no surprises, hopefully, from the ECB. The Fed does have a meeting next week that nobody knows about. No real surprises from the Bank of England. So in reality, very briefly, just sort of backing and filling with most of the majors to the end of the year, unless we have hopefully not a horrific geopolitical surprise?
One would assume so. So I think the dollar will probably have a reasonable last quarter. It generally tends to do well in November anyway, so I suspect we will see some resilience in the dollar. I think it's going to be not necessarily a broad brush process, but I think we will see speculative or selective gains in the dollar over the period. But yes, absent a geopolitical shock, which none of us obviously wish to forecast or see, then I think it is going to be the case that the central banks will do their level best, not to surprise and not to create instability through the course of the last quarter of the year.
Jeremy, thank you very much, and we will see you next month. And thank you for watching us. Have a lovely day.